Tokyo's core inflation has slowed and fallen below Japan's central bank target of 2%, raising new questions about the strength of the country's economic recovery. Core inflation measures price changes excluding fresh food, making it a key indicator of long-term economic trends rather than short-term price swings. Recent data shows Tokyo's core inflation has dropped to around 1.8%, slipping below the level policymakers consider healthy for stable growth. The slowdown is largely driven by easing food prices and weaker consumer demand, as households remain cautious about spending. For Japan's policymakers, this trend presents a challenge. The goal is to maintain moderate inflation while supporting economic expansion. Bank of Japan aims to keep inflation near 2% to avoid deflation and stimulate business investment. If inflation continues to weaken, the central bank may hesitate to raise interest rates, fearing it could slow the economy further. For consumers, slower inflation can offer short-term relief as prices rise more slowly and purchasing power stabilizes.
Wow, prices are coming down.
That's a relief. Let's stock up.
More cereal.
However, for businesses, softer inflation can signal weaker demand, reducing profits and discouraging future investment. Tokyo's inflation data is often seen as a preview of nationwide trends, making this slowdown a critical warning sign for Japan's economy. Global investors are watching closely, as Japan's economic direction can influence Asian markets and global financial stability. The coming months will be crucial. Policymakers must balance inflation control with economic growth to prevent another period of stagnation. Tokyo's falling inflation is not just a local story. It is a signal that Japan's economic recovery remains fragile and uncertain.